Drenard Trust here. Let's talk about the Direct Tax Code updates for 2025. Okay, let's talk about it. So the Direct Tax Code 2025 is a comprehensive overhaul in India's tax system set to replace the Income Tax Act of 1961. It aims to simplify and modernize tax laws, improve transparency, and increase the number of taxpayers in India. The key features of the DTC 2025 include simplified tax structure. This code reduces the number of sections from 298 to 319 and increases schedules from 14 to 22, making it easier to navigate. Updated terminology: income from salary becomes employment income, and income from other sources is renamed income from residuary sources. Revised residency rules: taxpayers will be classified as either residents or non-residents, eliminating the resident but not ordinarily resident (RNOR) category. Changes to capital gains taxation: capital gains will be taxed as regular income, potentially leading to higher tax rates for some taxpayers. Standardized corporate tax rates: both domestic and foreign companies will be subject to the same tax rates. Hit that subscribe button, hit that like button if you're educated, entertained. Hit that subscribe button, hit that like button. Hit it. Expanded tax audit roles: company secretaries will be allowed to conduct tax audits alongside chartered accountants. Removal of most deductions and exemptions: this aims to close loopholes and make the tax system fairer and more transparent. The DTC 2025 is expected to be introduced in the budget 2025 and implemented gradually thereafter. It is designed to align India's tax framework with global standards, improve corporate competitiveness, broaden the tax base, and ensure better revenue collection. The removal of the resident but not ordinarily resident (RNOR) classification under the Direct Tax Code 2025 will significantly simplify the tax system for many taxpayers. This change will have several effects, right? Clearer tax liability: the elimination of the RNOR category means that taxpayers will have a more straightforward understanding of their tax responsibilities. Residents will be taxed on their global income, while non-residents will be taxed only on their Indian source income. Potential increase in tax liability: some individuals who previously qualified as RNOR might face higher tax liabilities if they are now classified as residents. This is because residents are taxed on their worldwide income, whereas RNOR status provided certain exemptions on foreign income. Alignment with global standards: this simplified residential status aligns India's tax system more closely with international norms, potentially reducing confusion for individuals with international income or those who frequently move between countries. Reduce compliance burden: the removal of the RNOR category simplifies tax filing processes, potentially reducing the need for complex calculations and documentations related to determining RNOR status. Impact on returning Indians: individuals returning to India after long periods abroad may be more immediately subject to taxation on their global income if they meet the criteria for residency, as the transitional RNOR status will no longer be available. Now, what is the difference between the Direct Tax Code 2025 and the Income Tax Act of 1961? Now, there are several, and let's get into it. So, the main differences are the simplification, right? The DTC reduces the number of sections from 298 to 319 and increases schedules from 14 to 22, making it easier to navigate and understand. Terminology: the DTC updates income category names. For example, income from salary becomes employment income, and income from other sources is renamed income from residuary sources. Residential status is another one. The DTC simplifies the classification by removing the resident but not ordinarily resident (RNOR) category. Taxpayers will now be classified as either residents or non-residents. Financial year concept: the DTC eliminates the concepts of assessment year and previous year, using only the term financial year for tax filing. Capital gains taxation: under the DTC, capital gains will be taxed as regular income. Short-term gains on financial assets will be taxed at 20%, up from 15%, while long-term gains will be taxed at 12.5%, down from 20%. Corporate tax rates: the DTC proposes uniform corporate tax rates for both domestic and foreign companies, simplifying compliance and reducing disputes. Tax audits: the DTC expands the role of tax auditors, while the Income Tax Act only allows chartered accountants to conduct tax audits. The DTC permits company secretaries (CS) and cost and management accounts (CMA), right? Cost and management accountants to perform this function as well. Hit that subscribe button, hit that like button if you were educated, entertained. Hit that subscribe button, hit that like button. See you in the next video.